somebody has an idea that everyone agrees with, I start naturally thinking about the other side of it. Oh, it's still on?
Oh yeah, it's on.
I thought it was off. Okay, so as a value investor, we consider risk the permanent impairment of capital. That means that we have bought something and the underlying business has deteriorated, and when we go to sell it, we have to sell it for a loss. Or that we've paid too much for something, and as a result of that, there's no outcome other than to sell it for a loss. Other investors consider volatility, the ups and downs of the marketplace, the short-term ups and downs, as risk, which it's not really unless you have to take your money in 6 months' time to buy a house, or you have some kind of predetermined short and finite time frame for investing, in which case you should not be investing in fluctuating assets anyway. In our income value portfolios, we have tried to address both of these things. So again, as a value investor, we are looking to buy securities at a discount to their intrinsic value, and we do this, we look through this lens in our income value portfolios as well as our other business, and try and buy only undervalued securities. But recognizing that some people are simply uncomfortable with volatility, especially when it comes to income investing, we have created a broadly diverse portfolio, 5% maximum in any particular position, no averaging up, no averaging down. And as a result of that, we have created a low volatility portfolio experience. We also have 30 years of experience with investing techniques, hedging techniques, arbitrage techniques, and we will use those from time to time to mitigate actual capital risk where we see it. So we may be interested in a bond that's trading at a big discount, has a nice yield attached to it, but there's something about that bond that makes us uncomfortable. So we'll find a way of protecting our capital, perhaps by buying some kind of insurance contract related to another part of the capital structure. So there's several different concepts there, but essentially in the income value portfolios that we are now running, we are addressing the traditional view of a value investor of risk, which is, again, the permanent loss of capital, but also dealing with volatility, which is sometimes a perception that people have, or of risk, or a level of discomfort that they have with a portfolio. And I think that's especially important for investors, income investors, because by nature they're likely to be less tolerant to volatility.